From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views, and today's discussion is part of our series on Pillar 2, focused on the issues U.S. multinational corporations are facing. Today, we're moving away from covering some of the key Pillar 2 rules themselves, but instead considering the implications of these rules from a multi-state tax perspective. Joining me today in that discussion are two of Deloitte's multi-state partners, Jeff Burns and Alexis Morrison-Howe. Welcome, friends, to the podcast. And Jeff, I will start with you. Can you give us a high-level overview of the three core areas you see in Pillar 2 that are impacting state and local taxes?
Yeah, certainly, Carrie. As I look at those three core areas where Pillar 2 is going to have an impact on state and local tax, or state and local tax may have an impact on a company's Pillar 2 analysis, it really starts with the first piece being a definition of covered taxes. When you look at the Globe model rules, particularly under Section 4.2, there's 4 subparagraphs that discuss covered taxes. And as you dig into those subparagraphs a little bit more, you'll see one, clear that state taxes are covered taxes. But I think the question kind of becomes, as you look a little deeper into it, which state taxes, or what's my inventory of state taxes that need to be considered? The second one is really around global structures. So when we think about Tax Cuts and Jobs Acts, or TCJA, that really created an immediate impact on taxable income and a multitude of conformity issues at the state level. I think the related response drove this need to be really integrated in analyzing global structures. Pillar 2 is likely going to do the same thing. Now, not necessarily with respect to the impact of taxable income, but potentially magnified due to similar structural issues, but also the focus on a global minimum rate. And then the third piece is really going to be around state and local tax planning. State and local tax professionals should be thinking about how the domestic structure is going to be impacted by global planning, but really also need to have a lens towards what's the impact on the effective tax rate computation when we think about it from a Pillar 2 perspective. So those are really the three core areas that I think we should be really focused on from a state perspective.
Got it. Thanks. And so, Alexa, maybe I'll have you weigh in. Jeff talked about all of the rules and definitions around covered taxes in the 4 paragraphs that are part of the Pillar 2 guidance. Based on those definitions, what are the types of state and local taxes that should be considered in a covered tax calculation?
Carrie, that's a question where we have a lot of helpful guidance, but still some unanswered questions. The world of state tax is really so varied, and the OECD rules were not specifically geared to address everything related to U.S. subnational taxes. But here's what we do know. So Article 4.2, as Jeff said, addresses the definition of covered taxes. So the first type of tax that's included are taxes recorded in the financial accounts of an entity with respect to its income or profits, or its share of the income or profits of another entity that it owns an interest in. So this should generally include any state or local corporate income taxes. But in addition to that definition, are taxes imposed in lieu of a generally applicable corporate income tax and taxes on retained earnings and equity. So according to the OECD's commentary, these types of in lieu of taxes, they can include industry-specific taxes like an insurance premiums tax. It may also potentially include gross receipts taxes like the Ohio Commercial Activity Tax or the Washington Business and Occupation Tax that are imposed instead of a corporate income tax in those states. However, there are gross receipts taxes like the Tennessee Business Tax or the Oregon Commercial Activity Tax that may not qualify because they're imposed alongside state corporate income tax. So, query whether that's actually in lieu. However, a tax on retained earnings or equity, say like the Massachusetts net worth tax or the Tennessee franchise tax, could potentially apply, even though they're imposed in addition to an income-based tax, according to the OECD commentary. It's important to note that for purposes of the safe harbor transition calculation that companies are looking at now, the includable covered taxes determination is really simplified. It's based on current and uncapped deferred taxes recorded on qualified financial statements. So that's important to keep in mind as well.
Got it. And Jeff, maybe one last question on covered taxes. We know there's states that have concepts like worldwide or water edge reporting. And so how does that potentially impact non-US companies in determining their covered taxes?
When we think about worldwide or water's edge reporting, I really think there's a potential for state and local taxes to be allocated to those foreign entities that may otherwise be included in a worldwide or a water's edge return. If they're part of that group and they're incurring some of the liability, there's a likelihood that there's going to be a push of that state tax back to that foreign entity. And then there's going to have to be consideration given to that from a Pillar 2 global minimum rate calculation point of view, especially as it relates to covered tax. And then I also want to say, I think further consideration should be given relative to any other state and local tax filings that a non-US company may incur. If there are certain filings where the non-US entities filing on its own, incurring a franchise tax, as Alexa spoke about, incurring an income tax, those are also going to have to be considered as well when looking at the covered tax calculation and analysis. And any other areas, for example, outside of those unitary or combined returns, those separate filings that may be required for the non-US entities, just take a fresh look at those, make sure we understand how those impact covered taxes and whether or not there's some state and local tax allocation to those entities.
Right. That's covered taxes. But Jeff, you also mentioned other potential state and local tax impacts that companies should be thinking about as they review their global structure as a result of Pillar 2. And maybe you can talk through some of those potential impacts with us.
So I think the first area, it's really going to sound all too familiar to state and local tax professionals, but consideration should be given to any conformity issues that are going to happen at the state level. That includes areas, not limited to federal versus state basis, federal versus state previously taxed earnings and profits, the consolidated regulations primarily related to deferral. Those are just some of the areas that from a state and local tax perspective will need to be analyzed as organizations reassess their global structure. The other area that needs to be thought through is we are living in an era of economic nexus, market-based sourcing, state and local tax filing group compositions that may include non-US entities. Looking at all of that holistically and that as a background, companies, when analyzing the global structures, need to consider what activity those non-US entities have in the US with that state and local tax lens. This is going to impact a number of the computations or data points for Pillar 2 purposes, but effectively impact the result with respect to the minimum ETR when we look at it on a constituent entity by entity basis. So those are really the two areas when I think about what's happening on a global level that could have an impact to state and local tax when we think about the structure as a whole.
Alexis, other areas that you would bring into this discussion?
Yeah, it really is. As Jeff mentioned, planning undertaken in response to Pillar 2 can have a direct state tax impact. As he was saying, that there's significant ways that state rules can vary from the federal consolidated return rules that non-state practitioners are used to. Foreign entities can be subject to tax beyond their effectively connected income. They can be included in combined state returns with U.S. entities. An entity that's part of a different consolidated group for federal is often the part of the same return as the rest of the U.S. for state tax purposes. I could go on, but usually any plan to onshore activities to the U.S. is going to have state ramifications, and some of them can be unexpected for non-state practitioners. Conversely, companies may be in the midst of looking at ways to reduce state income taxes, through beneficial apportionment positions, restructurings, refund claims, you name it. But if the state tax team is doing that in a vacuum without communicating that impact to the broader tax team to understand the impact on global ETR, this can result in unintended negative consequences. It sort of boils down to this. A home run answer for Pillar 2 may be negative from a state tax perspective, and a home run answer for state tax can be negative if it drives their global ETR too low. So, the clear message from this is that everyone in the tax department needs to be talking and needs to be aligned on what's the best answer for the overall tax posture of the company.
And that's certainly new, right? We've been talking for a long time about how federal and global restructurings and plannings have a state implication. Now, maybe for the first time, those same activities at the state level will have broader implications. So I agree completely with you, Alexis, that we've got to make sure all parts of an organization are talking to one another so that they can understand the knock-on implications. All right. So lastly, I love both of your comments on what some of the initial steps companies should be taking so that they can understand the state impacts that we discussed today.
I'll go ahead and start us off. When I think about those initial steps that a company should take, the first place I would start absolutely is have a deep knowledge and understanding of your state and local tax profile, not only for your US companies, but also your non-US entities. As I mentioned earlier, there could be a number of situations where your non-US entities have a state and local tax impact, liability, assessment, et cetera. Really understanding that and having a deep knowledge of it is going to be key. The second piece is really ensuring you have the appropriate inventory of all your state and local tax attributes, including your credits, your incentives, and net operating losses. All important things to have an inventory of. And then as Alexis mentioned, and we're talking here, is just making sure that you're coordinated effectively across the tax department. And anything that's happening from an analysis point of view around data sets for Pillar 2 purposes, really make sure that state and local tax professionals are involved in that and also leveraging those data sets to arrive at the appropriate state and local tax answer from a Pillar 2 perspective overall. Alexis, anything else that you might add to that?
No, I think that's right, Jeff. The clear message is now more than ever, we can't be working in our silos. We really have to be aligned and communicating across all of these issues because, we can really help each other from our respective disciplines to get to good answers.
Well, that is a great note to end on. Thank you, Jeff and Alexis. I really appreciate that information. And it is important for organizations to be considering all these things as they work their way through the dynamics of Pillar 2. So if our audience would like more information, you can connect with Jeff and Alexis directly via LinkedIn. You can also download the Tax at Hand app. You can find it on all the app stores, and there you can search and find a number of materials covering Pillar 2. We also hope you continue to tune in here for the other episodes in this series on Pillar 2. But in the meantime, I'd like to thank you all for listening in, and I hope you continue to be well.